Hey, this is Ken Finnan at Capital Advantage Tutoring, and it's time for another way too fast rundown on security shit. It's my job to get you past the SIE in Series 7. So I get a lot of this. I get this question a ton of times. What's the first market, second market, primary market, secondary market? So we're going to work on that. So let's go. Okay, so we have two markets, the primary market and the secondary market. The primary market is where companies are raising money. They can do debt, they can equity, they're issuing shares or debt or whatever it is to bring money into the company. They're raising money. That's the primary market. If you hear the word issuer transaction, that's what we're talking about. So these are the key words. First of all, covered by the Act of 1933, which covers all the primary market stuff. How to raise money, because they had to put rules on them, because they're really being abusive and not. It's all about disclosure. So in the primary market, we're disclosing stuff, okay? So we're all disclosing our financials and all that under a set format so that you can actually compare different companies. So if you see the words like new issue, IPO, syndicate process, underwriting, all or none offering, mini maxi, best efforts, I probably should have wrote it there, best efforts, those are all keywords to know that it's probably about the primary market and we're looking to raise money. That's what the companies are doing. That's raising money. There are exceptions to that, which I have a couple of videos on, but that's what this is. That's the primary market. Okay, so now let's jump over to the secondary market. That's where the shit goes after it's been issued. People want to buy and sell it. So the secondary market is all about trading. And what act covers that? The Act of 34. The Act of 34 covers trading markets. It's a whole acronym that I do called MISPERMS. Maybe I'll do a video on that. I have one on YouTube on that, but let's see if I do one on here. So Act of 34 covers all the secondary market act, all the trading, the exchanges, stuff like that. But people want to talk about the different markets. So let's do that. So we have the first market, which is all the exchanges. The first market is New York Stock Exchange, NASDAQ. They're exchanges. They're exchange listed. That's the way they explain it. It's a listed security that's listed on the exchanges. They're listed securities. Those are all the companies you've heard of. Tesla, Microsoft, IBM, Ford, General Electric, General Motors, all those companies trade on the exchange. They're the top companies and they're very liquid, very actively trading, and you're trading through the exchange. Then we have over the counter. There are two levels of over the counter equity and over the counter debt. Pretty much all bonds trade over the counter. There's a couple on exchanges, but as far as we're concerned, bonds trade over the counter. And then OTC equity. These are shares or stocks that are not big enough to meet the listing requirements for the exchanges, so they trade over the counter. Now, what the hell does over the counter mean? That means directly to broker-dealer doing trades, not included in exchange. They call it an over the counter because it used to be over your desk, over your counter. You would call up and do trades. When I first started, we were all on the phones, no computers. Now it's mostly computerized, so it's a little more liquid and a little more price discovery. But seriously, when we first started doing it, we had to get on the phones and call up and go, do you have shares? No, who does? But all over the place. It was crazy. But over-the-counter equity used to be the pink sheets and bulletin boards. They're getting rid of the bulletin boards in October of 2021, which is in the future. But if you watch this in 6 months, it's the past. So it's going to be OTC equity. It's really, they're not very liquid. They're not very active. That doesn't automatically mean they're penny stocks. It just means they're not liquid or active. So they're a little riskier in a way. Then we have the third market, over-the-counter trading of listed securities. Let's make this look a little nicer. There we go. Over-the-counter trading of listed securities. That means we're taking listed securities, shares that trade on the stock exchanges, IBM, Ford, General Motors, all of them, and we're trading them broker-dealer to broker-dealer. We're trading them among ourselves, okay? Meaning the broker-dealers. Goldman buying from Deutsche Bank buying from Nomura, stuff like that. They're actually trading over-the-counter, not on an exchange. It's an alternative. So like IBM trades on the New York Stock Exchange, but it also, people can also trade it. Firms can also trade it over the counter. Now, the last one, fourth market, that's institution to institution trading. So there's dark pools, private transactions between the institutions, non-broker dealers. Like, understand something. To do an actual trade, you're supposed to do it through a broker dealer. That's FINRA and SEC rules. If you do a trade on a securities, it has to be done through the exchanges or through a broker dealer. The fourth market, you don't have to do that. That allows mutual funds and hedge funds and non-broker dealers and banks to trade with each other on private transactions. Maybe they want to do it without moving the market.